Hey folks, it's Rod with Pow Group. Welcome back on the Pursuit of Wealth, your home for MJ stocks, crypto assets, and interviews. We also cover the real estate market from time to time, and that's what we'll be doing in today's video. We're going to be discussing an article from CNBC and mortgage rates hitting the highest level since 2000. We're going to discuss all of that and more. Before we get to it though, make sure to smash the like, help support me in the channel. It doesn't cost you anything. If you're new, you can subscribe, tick the bell, all that good stuff. You'll be notified on any future live streams or when I post a new video. Today is Monday, August 21st. Hope you had a great weekend. And before we dive into the article and a few other things, I did launch the Pow Group merch store. So there was a lot of people asking for this, and we delivered. So you can go to the channel, just go over to the store page here, or you can go to powgroup.ca or pursuitofwealthgroup.com, click on merch, and that will take you to the store as well. But shout out to Paul A, who was the first to order an order on the Pow merch store. Also, make sure to give Pow Group a follow on X, which is formerly Twitter. The handle for that is @GroupPow. Again, it's @GroupPow on X. I'll be using that as my social media platform of choice going forward. So here's the article from CNBC. Mortgage rates hit their highest point since 2000. Mortgage rates soared to the highest level since November 2000, crushing affordability for potential home buyers. The average rate on the popular 30-year fixed mortgage hit 7.48%, according to Mortgage News Daily. The average on the 30-year fixed last year around this time was around 5.5%. And if we take a look at the mortgage rate history, and the reason why I'm bringing this up is to kind of put things into perspective. But we have to remember that home prices weren't the same back then either, which I'm going to bring up another article to show that point here in a moment. But the reason why I make this video isn't to make people fearful or anything like that. It's just to basically send out a warning that this could get worse before it gets better. And we need to have a plan before you know what hits the fan, right? Instead of being, reactionary, we can look at this from a proactive standpoint, and we can start to make plans now, right? And if we take a look at the mortgage rate history here, according to Super Brokers, back in 1981, it was actually the highest. It was at the variable rate was at 19.2, and the 5-year fixed rate was at 18.13. And then in 1982, the 5-year was at 19.25, right? So it could easily go. The average is around 7 to 8%. So if you take a look at, the trend, we were dipping. I got a mortgage rate a couple of years ago here in Edmonton on a condo for just under 3%. I don't think it's going to go back that low, maybe ever, but I don't think it's going to go that low. We could see it dip down to around maybe 3 or 4%. And, start to cool off a little bit. But ultimately, this could go to 8, 9%, right? So we have to be realistic. And if it was at this percentage at one point, it can definitely go back there again. But again, the housing prices weren't the same, which we'll look at in a second. So I don't think it's going to go back to, 20% on $1 million home or $1.5 million, dollar home. That's not really realistic. But if we take a look at if we go to FRED, economic data, you can see here that the 30-year fixed rate mortgage average in the United States since all the way back here in the 70s, you can see here that we started to trend up. We went as high as, like I said, into the 18 percentile and then 19 percentile. And then it's just been a straight slide ever since, right? And now you can start to see the trend is breaking with higher lows and higher highs. We're breaking previous resistances here on the chart, signaling that we could be seeing a huge reversal, which we are, but it means that we could potentially see even more upside in these rates, right? So again, this isn't to be an alarmist. This is just to be a realist and paint the picture that things could get worse before they get better. Now, if we take a look at the New York Times, housing prices average back in 1981 was $80,600. So the average home price was only $80,000, just over $80,000, right? So if you take a look at the actual mortgage rates, right, back in 1981, if it was around 18, 19%, that's not that bad on an average home price of $80,000, right? But then there's inflation and then the purchasing power of the dollar being deflated, right? Because of all of the money printing, right? And not being backed by anything, right? It's just fiat currency. And ever since, the U.S. removed it from the gold standard, the U.S. dollar, right? It's just been eroding the purchasing power. So again, the interest rates probably aren't going to go that high. I don't think they would go over 12% because it just wouldn't be sustainable. Like it wouldn't make any economic sense with home prices as high as they are. If you take a look at the home prices right now, you can see here the median existing home price also broke through $400,000 for the first time in 2023, hitting $410,200, the second highest price ever recorded, and is now poised to surpass June 2022 all-time high of $413,800, right? So again, home prices now not the same. So I don't think they'll raise interest rates as high. I don't think it's feasibly possible because just nobody will be able to afford that, right? Not on a $500,000 home or $1 million home plus, right? But something we have to remember as well, and I did videos on this as well, is that mortgage payments could go up as much as 20 to 40% as per the Bank of Canada. So if you take a look at that, that could happen. And if you're paying a mortgage right now and you bought, in 2020 or 2021, that means that most people's mortgage, their 5-year fix, will renew in 2025 and 2026. So you need to start planning for that now, right? Again, not to be spreading fear or anything like that. I'm just trying to get everybody to think about this now before it becomes an issue and people get overwhelmed, right? A lot of people just kind of bury their head in the sand and deal with it when the time comes. But I think it's going to pay multiple dividends if a lot of people start to plan for this inevitability in the next couple of years. Because like I said, a lot of people bought housing during 2020, 2021, the low rates, but the price of the homes were extremely high, right? So if rates continue to go up, it's going to create defaults like you wouldn't believe, right? But here's an article as well from the Beaverton. Corporations hoarding homes thank Canadians for enthusiastically blaming immigration. And then if you go down, I'm not going to go through the whole entire article, but it says, as housing unaffordability rages out of control, the loose coalition of corporate landlords, investment property flippers, Airbnb moguls, REITs, so real estate investment trusts, and foreign real estate money launderers held a brief press conference thanking Canadians for training their public outrage solely on immigration. So there's a lot of moving parts here. I, for one, just purchased a second condo here in Edmonton, and I'm using it solely as an Airbnb. I'm making a ton of cash flow on that per month, and then hopefully, the condo market has just been dropping for the last 15 years. In some cases, some condos down 50 to 70% from 2007. So I'm looking to cash flow the property, make good cash flow on a month-to-month basis, and then also double dip into the appreciation of the home, right? So I've done a video on that. You can check that out. And speaking of which, I've also done a video on Edmonton and Calgary being the top searched for real estate. So how did I know that Calgary and Edmonton were probably in Alberta was going to rebound, right? It's because the prices, while most of the rest of Canada was going up, right? Housing prices here isn't that low. If you take a look at the actual benchmark here, single family home price decreased by 0.9% year over year to $834,500 in July 2023, right? So if we take a look at that compared to Edmonton, the average home price sold for $440,000. So monthly change of 37.6%. So it's still very, very low compared to Canada's benchmark single family home. And then if we take a look at the condo apartment benchmark, it's at $550,000. Like I said, there's no shortage of condos here in Edmonton, from anywhere from $70,000 to $100,000. There's tons of them in that range. There's a ton in the $100 to $150 range, all the way up to $1 million, right? And then Canada's average rent for a one-bedroom apartment increased 13% year over year to $1,850. So again, we're not really on par with the rest of the Canadian market. And again, it's a far cry from where we were back in 1981. It just goes to show you how the purchasing power of the dollar and how things have changed, right? 80,600, right? So if we take a look at where we are to where we were, it's possible that things could continue to go up. But at this point, I think Edmonton offers some really, really great opportunities. Alberta as a whole, especially with regards to the condo market. I think that, housing prices right now here in Alberta, they may continue to come down, but I think the best bang for your buck right now is condos, because if affordability is an issue and interest rates are high, people are going to be looking towards condos, right, as a way to get into the market for cheap, and they don't really care about, who cares about a 7% interest rate or 9% interest rate if the condo is only $100,000. But if it's a $500,000 home or $1 million home, 7% to 9% is a big jump and makes a big difference, right? So I think, and then a lot of people just aren't going to care about interest rates. They're just going to care about affordability and living in a home and owning equity in a home. And that's why I think condos are going to be really great here over the next decade or so here in the Alberta market. But let me know what you think of this. Let me know if you're impacted by this. I'm really excited to read the comments in this video. Is this something you're preparing for now? Do you think that interest rates have peaked? Do you think we're going to continue to go up from here? Or do you think we'll cool down? Like I said, I think we'll go to around 8-9%, and then maybe it'll drop to around 4 or 5%, and then maybe gradually start to increase back up from there. But usually hovers around that 6 to 8% rate average for interest rates. But Always love hearing your thoughts and opinions going in it there, though. It's Rod with Powell Group. Thanks again for joining us on the Pursuit of Wealth, and we'll see you again on the next video. Take care.